Live. James Ing, how are you?
How's it going, Zach? Thanks for having me today.
Yeah, no problem. I would say you are the motivation behind this distribution channel. I had something in mind, but you kind of encouraged me. He's like, "Why don't you just start it?" And so I would say kudos to you for inspiring me.
It's always hard going 0 to 1. So I always say you got to start, you got to learn. That's the only way. I think it's very similar to multifamily. Getting that first deal done. I always say there's like a pack of people sort of stuck at zero. And then
Yeah,
once you go to one, you are like your education is like expanded. And I can tell just comparing a couple months ago when our first webcast, you are already very much more prepared. So I appreciate you having me on. Try to add as much value as possible for your listeners and watchers.
yeah. So I mean, if people don't know who you are, your YouTube channel is one of the best educational platforms out there, and I recommend anyone who's learning about multifamily or anything to go check you out. But just if you want to share a couple minutes of how you started and how are you in the position where you are at Old Capital?
Yeah, I was actually born and raised in Houston. So where you're sitting, that's where I was born and raised
Yeah,
in Houston. Grew up there my whole life, and then went to school in Austin at UT, and did finance there. And when I came out, essentially was in sort of a corporate finance leadership program where I went state to state with GE Capital, and ended up in Dallas in their commercial real estate group. And for essentially 10 years, I underwrote properties. So commercial real estate properties all throughout the US, office, industrial, retail. It was funny back then, my chief risk officer knew how bad retail and hotel was. And that was, 5 years ago. So he was ahead of the curve. And then after 2015, we sold our entire platform to Blackstone. And I said, all right, I got to start investing, start doing more stuff within the multifamily space. Because when I was at GE, basically I was there from 2007 to 2015. And for the first 3 or 4 years, we were originating loans, doing stuff. And then once the downturn hit, the 08, 09, 10 downturn, we took back every type of property that we originated. So we were doing bridge loans, we were doing CMBS loans. We took back everything except really multifamily and self-storage. So when I came out, I said, all right, I got to start investing in stuff. And so I really looked heavily in multifamily. I looked heavily in self-storage. And what I found is I had a lot more opportunities in multifamily. So there was a lot more education. There was a lot more syndications. There's a lot more opportunity there compared to self-storage for me personally in the network that I had. And so I started investing in multifamily. And then I also joined Old Capital. And Old Capital is a mortgage broker. So we help you find the best debt for your transaction. So whether you're buying $1 million deal or a $20 million deal, we are working with you to find the best lender. And so in the last 5 years, I've done about 800 million in multifamily loans across 125 properties, most of them in Texas, but also throughout the nation. So that's it.
yeah. When you were underwriting at GE, did you have the mindset that you were going to invest in multifamily as well, or did that come after the '08 recession?
It was more probably 2012, 2013. I started looking a little bit more heavily at it because when I was at GE, the only thing that I really had was 401k Roth IRA. That's all I had, right?
Yeah,
And so not until I really started thinking, all right, if something happens with my job and I have to live off of these investments, could I do it? And 401k was paying me nothing. Roth IRA was paying me nothing. And then the cash sitting in my savings was paying me nothing. So essentially I said, I need to start investing in some stuff that is going to pay me, and this is the key word, monthly realized income, which is something that you can actually spend. Like the same way that your expenses come in monthly, you need your income to come in monthly.
yeah, yeah. So I mean, I think that's a great segue for this class's session, and you're going to be the professor for it. Is
Okay.
what you do at Old Capital as someone who's thinking about starting to invest or transitioning from single family homes to buy their first multifamily homes. what does the lending process looks like? From a high level, what are some challenges that I'm going to face when I come to you, and how can I be prepared?
Yeah, I mean, I think I would start. I try to use, like, if you try to realize, put a chart in front of your head. Um, so if you start on the far left hand side, I like to call that sort of like your recourse bank loan. Okay, that is your first step. That's what most investors are going to start with. All right, and then the middle two columns. So we have four columns: recourse bank loan. Then you have Fannie Mae. Then you have Freddie Mac, and then you have non-recourse bridge. Those are the four columns. The left-hand side on the recourse bank loan, that's going to be your most basic loan. You're probably at 75% loan to value. It's a 5-year loan, and you might get 1 year interest only, and then it'll go 20 to 25-year AM. So that is what single family investors are typically used to. It's going to be a recourse loan. So that means that if something happens and the bank forecloses, you are responsible for any deficit. All right. So that's your recourse side. And then as you get more and more experience, you're going to move into Fannie Mae and Freddie Mac. And so those are non-recourse loans. They're 5, 7, 10-year terms. And, the rates on those are probably in the low 3s to 4s right now, just depending on the term and the prepayment penalty that you have. And then as you get more and more experience and you want to take on a little bit, maybe a more challenging property that doesn't qualify Fannie and Freddie, then you end up on the far right-hand side. That's your non-recourse bridge. And so this is going to be, typically 2 to 3 years on a bridge loan, interest only for the whole time. But it's going to be for more experienced people. So you're going to have a maturity at the end of that 3 years. And so that's how I like to think about it. Sort of starting on the left-hand side with the recourse bank loan, getting some experience, going to Fannie and Freddie. And then if you have a lot more experience, you're taking on a little bit more challenging property, then you go non-recourse bridge. So that is the I'm trying to think what an overview of what investors should think about when they are looking at property.
Right. And so if I were to come to you, and just give you an example, I have a 30-unit deal in Houston, Texas. What is the first things you're going to be asking me if, I don't have the experience of investing in multifamily beforehand?
So the first question I'm going to ask you is, what is the occupancy of the property? All right. So if it's 90% or higher, it can qualify Fannie Freddie. Okay. Mm-hmm. And then I'm going to ask you about your net worth and liquidity. So you need a personal financial statement. And let's just use an easy example. Let's say that 30 units is $3 million.
Yep.
And I say, all right, this loan this qualifies for a $2 million loan. And, you need, as a sponsor or the sponsorship group, so you can have multiple people do this, $2 million net worth and $200,000 in post-close liquidity. So the loan amount, or your net worth needs to be greater or equal to the loan amount, and then you need 10% of that loan amount in post-close liquidity. So that's after the down payment. You need that much in post-close liquidity. So that's the second question. And then the third thing I'm going to ask you is, what's your experience level? If you have no experience, then it is going to be more difficult to qualify for Fannie and Freddie, but you could bring on somebody who has experience onto your sponsorship team, and then you could get into that Fannie Freddie club and then qualify for those loans. And then the last question I'm going to ask you is, who's going to manage the property? So who's your property manager? 30 units, you're probably right on that line between self-management and third party. But if it's your first deal, you're probably going to want just third party, just because it's going to be, your lender is probably going to require it.
Right. And for myself, how do I get the non-recourse loan?
So if you're going to sign, let's say you're buying the deal on your own with your own money, and it's your first deal, you're probably not. You're probably going to do a recourse bank loan for your first deal, because what that recourse bank lender is going to want is a secondary source of income. So if there's an issue with that property, then they're going to count on you. So they're going to look at your tax returns. They're going to look at what other jobs do you have. Maybe you or your spouse is a doctor, lawyer, accountant, something else. And they're going to look at that income to make sure that if the property can't pay the debt service, that you can.
Right, right. And what do you see are common challenges in this era at the moment, during COVID, that you're seeing as people starting to invest in their first multifamily?
Right now, some people, it is more difficult, I would say, on the equity side of the equation right now, because a lot of people, it was actually pretty easy to raise equity the last couple of years. Everybody wanted to be in multifamily. Everybody had a job. Everybody, the stock market was doing well. Stock market's still doing well, but people are a little bit more nervous, right? And so they're saying, is now the right time to invest? And so that's going, that's in the psyche of limited partners. So I would say number one is equity. Number two is just, the amount of lenders in the space, right? So if you go back to sort of those four loan types, there are less recourse bank lenders and there are less non-recourse bridge lenders. And so before, if let's say you were not as experienced, or maybe you didn't have that big of a track record, not that much in net worth and liquidity, you could find a bridge lender out there, right? Whether on the recourse side or non-recourse side, because there was 10 bridge guys and they were all competing against each other. And so there was plenty of competition. And so people sort of lessened their underwriting standards on deals. But now there's one bridge guy or two bridge guys. And so they know that, and they're going to put stricter requirements on the underwriting of deals. And so your sponsorship team needs to be that much stronger. And so I would say that's probably second. So one is equity, two is debt on these deals. And then third is just, there's not actually that much inventory on the market right now. So I would say, let's say January, February, first quarter of this year in DFW, there might've been like 30 deals on the market. And, in March and April, it went to 2, right? And so it slowly has trickled back. I would say starting over the summer, maybe June, July, you're probably up to 5 to 10 deals right now in a major MSA, but it hasn't gotten back to where it was. A lot of people, especially sellers right now, unless they really need to sell, they're sort of just sitting on the sidelines right now.
Yeah. And what do you think is the difference from a lending perspective of what you were seeing during 2008 versus now 2020? In 2008, I was sort of in a different seat, right? Because we were lending on everything, and we were mostly bridge lenders. And so right now, the lending piece is very fragmented between property types, right? So I can't remember the number, but like it was like hotel lending was down like 90%. Retail lending was down like 70%. Like multifamily was down, right? But it was only down like 30 or 40%. And that was sort of quarter over quarter. And that was really driven by just, there wasn't as many acquisitions. Like the financing was there. So Fannie and Freddie were there in comparison to a lot of other property types. The only other darling right now in property types is industrial. But every other property type, office, retail, hotels, all those, it is very difficult on the financing side right now. Yeah. And, what are you seeing the next, it's hard to anticipate, but these next 3 to 5 years of what asset classes lenders will be more open and willingness to lend to than maybe hospitality may be on the lower end?
It's funny. It's like after a couple of years, everyone forgets.
Yeah.
But you as an investor should remember this as a time that people, that multifamily, like even through a pandemic that we haven't seen in 70 years or whatever it was, it still survived. And so, I think multifamily is at the top of the list. A lot of people have self-storage on that list as well. I like multifamily more than self-storage. And then, industrial's there. I mean, a lot of these larger institutional players like industrial because it's not as management intensive, and they can just sign a lease with Amazon for 20 years and they're good. But for a individual investor, it is harder because we saw, so I did some like $5 to $10 million bridge loans on industrial. And a lot of times that's like 1, 2, 3 tenants at your property, right? They're taking up, 100,000 square feet of space each person. And one of those tenants goes out for whatever reason, then you're in trouble, right? So your occupancy, goes down to 60% and you're in trouble. And so a lot of those deals, even though people like industrial, it still is, it's a tougher segment for individual investors compared to multifamily in my eyes.
Yeah, and I was watching a prominent investor in Houston talk about, there hasn't been that many distressed assets in the value add that people wanted to during this time, but he said two things that could happen. Tax appraisals could cause that, and also the people that have mezz debt on top of their deals, they could get in trouble. Is that something you've been seeing as well that could potentially be an opportunity for investors to come in?
Well, right now it's all about stimulus. And what COVID did in March, when the government essentially shut everything down, they've paid people, and that money has essentially gone from the government to the stimulus checks to unemployment, and that has come back to landlords. And so collections across the board for apartments the last 3-4 months, April, May, June, July, August, they've been 95 plus. So the only distress that we're seeing is if there was a problem back in March, right? If your occupancy was already 75 or 85%, COVID put a whammy on you and you're pretty much in trouble. And we're seeing those people request forbearances from Fannie and Freddie. So about 1% of the book for Fannie is in forbearance right now. So some of those people are in trouble. But outside of that, pretty much every property that I'm invested in, when I talk to deal sponsors that on deals that we finance, they're doing fine, right? There's been no distress. And so I would say probably the distress is probably on the rental growth, right? So if you thought, all right, coming in 2020, I'm going to crank rents 3 to 4%. If I do a rehab, I'm going to get a 10% rent premium. It's not there right now.
Yeah.
So I would say the rental growth is struggling. The occupancy is full. Everybody's full right now, especially B and C properties. Their occupancies are 95 plus.
Do you think, though, some of the reporting might be misskewed of what the national rent apartment are reporting, that 90% collections of this month compared to last year? Do you think there might be some discrepancies there that's not fully accurate, or what are you saying?
I would say in Texas, it's better than national. In New York, California, it's worse. Chicago, like in those major metros. And if you're a Class A deal in a downtown area, it's worse probably. So most of the deals that I finance and that I invest in are sort of B and C properties, suburban properties, garden style walk up, and those are doing great right now.
Yeah. And let's say you have a deal and you're going through this pandemic. How should they be communicating with you from a lender perspective?
Right now collections is a big deal. So what I'm seeing people is letting the lender know sort of where their collections were at, in March and April and May, it was probably a weekly or biweekly, but right now I would say it's a monthly. So by the 15th, like around now, you should be giving, your lender a heads up sort of on August collections. I would also focus in on making sure if you just bought the deal, making sure that all sort of your CapEx is done. And in terms of immediate repairs, most of your sort of elective CapEx, most of the time you have 1 year to do it. And so I would just be in contact with your lender and just say, look, we're not doing interior rehabs right now. We're not seeing the rent bump. Let's just hold that money aside, keep it sort of as a replacement reserve. And, if the market gets better next year, we'll start doing those. But right now we're full. We're not gonna try to kick people out to try to do a $5,000 or $10,000 a door rehab on the interiors.
Yeah, that makes sense. And some of the research I've done with the cap rates compressing and the money's so cheap right now, historic lows. Can you give me further explanation on why that is, and how does that affect prices moving forward? Because right now I feel like there's a delta or a big discrepancy between asking price and buyers' willingness to pay for a property.
Yeah, I mean, right now, Marcus Millichap showed a chart that, back in 2007, 2008, the gap between, let's say, the 10-year treasury, which is the risk-free rate, and the apartment cap rate was like 200 to 250 basis points, which is not much because typically there's a spread over your debt as well. And right now, the apartment cap rate, let's say it's 5, the 10-year treasury is 0.5. So you're at 450 to 500 basis points on your spread. And so that's why investors are still coming in and buying deals, because you have not gotten, let's say, a discount on price, but you are right now getting a discount on debt, because in January you were probably at 4% all in on your interest rate for Fannie Mae, and right now it's probably in the low 3s. And so that change of about 25% is lowering your cost of capital, which should improve your cash on cash. And so a lot of investors are focused on cash on cash. Year 1, year 2, what are you going to pay me? And if you can pay me a 6, 7, 8% cash on cash, especially a lot of these deals are getting anywhere from 3 to 5 years interest only. If you can pay me that cash on cash, I'll sit here and wait, right? Instead of my money sitting in cash, I'll sit here and wait and collect 6, 7, 8% cash on cash all day.
Yeah, and not really worry about the rent growth.
Yeah, I mean, it's more in place, what you're going in cash on cash, and then maybe there's occupancy improvements, maybe there's expense improvements to really drive that cash on cash from a 6 to 7 to maybe 8 or 9.
Mm-hmm. Yeah, no, that makes sense. And with, the debt being so so cheap, what is this, pumping all this stimulus money into the economy going to affect this moving forward?
That's, a lot of people think it's going to spur on a lot of inflation, right? And inflation, I would say, is pretty good for real estate investors. So I think that's the right place to be. But I think the Fed is trying to keep us out of deflation, because deflation is probably the worst spiral, because if things are going to get cheaper over time, you're just going to wait and wait and wait and not buy anything. And 70% of the economy is consumer purchases. So they want inflation, and they've continued to pump money into the system, and nobody really knows. For the last, I can't remember the numbers exactly, but it took them probably 2 years to put as much stimulus as they did in like the first month that they did this time on this transaction, on this downturn. And I was listening to another webinar where they showed that the contraction for Q2 on the GDP was about 32%. But if the government didn't do anything, it was probably like 40. It would have been 47 or 48%. So the government helped us a little bit, but nothing's going to stop a full shutdown on your economy. So yeah.
No, I think this has been helpful, just from a first-time investor's point of view on the requirements, the questions you're going to be asking them so they can get prepared. It seemed like, having liquidity of $2 million, having multifamily experience, the occupancy to be able to get that Fannie or Freddie loan. Is there anything else I'm missing?
No, I mean, I think, the first thing I would say is start sort of with your personal financial statement. All right. Do your personal financial statement, figure out sort of what you could qualify for. And then if you are going to go out and target properties that are larger, you need 2, 3, 4 people that are going to sign with you on that deal. And so you need to start thinking about what other general partners are going to help me do this. Right. And then as you start building out your team, start thinking about, really, there's like 4 things that you need to get a deal done. One is the deal. So someone's going to have to go out there, meet brokers like yourself, find deals. Second is somebody with multifamily experience. Third is someone who has net worth and liquidity. And then fourth is the ability to raise equity. So as you go out there, start building your team, start thinking about who's checking those 4 boxes, because if you're missing one of those, you're in trouble. You're not going to be able to complete the deal. So, and then if you aren't checking one of those boxes, then start adding to your resume things that you can do to improve, your ability to raise equity, your ability to find the deal. All those things help, because when we see people, I've done 100 plus transactions, and every one of these operating agreements, they're cutting up a pie. And let's say there's 20% of the partnership money or the distributions are going to the general partners. the people with more of those items are getting a bigger slice of the pie. And so what you want to do is basically, you might start at 1% just because you're a balance sheet guy, you're putting in net worth and liquidity, but you don't have the experience. But then the next time you have multifamily experience, you got net worth and liquidity, and you raise some equity. So all of a sudden now you're getting 5%. And then once you have a couple deals, brokers are calling you, and you just do the deal on your own and you get 20%. Like that's how people grow up in this business, and you just have to take it one step at a time.
Yeah, I mean, I think you're going to put Harvard business out of school with the knowledge that you just dropped.
Yeah, I mean, it's funny, like Harvard and all these guys are all online. One of my favorite quotes from Kiyosaki is, the best teachers are on YouTube. So get on YouTube, start going through some of this stuff, go back to the beginning, watch it again. I think that's where people are going to learn. And, I constantly, watch what other general partners are doing, talk to limited partners all the time, talk to listing brokers like yourself on what's going on in the market, just to become a better investor. Because I think everybody at some point has to learn how to invest their money. And whether it's multifamily, whether it's another asset type, becoming a better investor is a skill that you need as an individual, to me.
Yeah, no, I appreciate it. I appreciate it a lot. And just, we haven't met in person yet, but we've had a virtual relationship thus far. And I've kind of followed you, the past few months on your career and read up on you and seen what you've put out. But, just from where you are now to where you began when you were at UT, what are you most proud of in your multifamily career?
It's one of those things that like you just sort of pull on like threads, right? And you don't know what it's going to lead to. And so when I started out at UT, I still remember like going up to Connecticut for my first rotation at GE. And there was like, I didn't know anything. I was just, coming out of school, like you think after 4 years doing finance at like a top, 10 school or whatever in business, you would know something, but really you don't know anything. And so I remember showing up and just doing like accounting at GE corporate, right? And then going to an IT business and going to real estate business. You thought like you knew something, but you didn't. Every time, just having to constantly learn. And so I think it's more of I'm most proud of is the transformation piece throughout it. And like when I see somebody, like when I was at GE, I used to recruit students that were into GE's leadership programs, right? So I go back to UT and talk about that. And like seeing those people go from, the same place that I was, but like to help them along the journey and really mentor them across GE, but then also across their careers. Because a lot of these people, went to Harvard, actually, one of the people that I worked with. So it's just, that's the part that I like actually the best. And so like when I'm able to take somebody from like they meet me, they watch a YouTube video or they hear our podcast or, we talk and I sort of give them this game plan and say, all right, these are the steps. And they go out, and, they check in maybe once a month and, we get a deal done. And they're able to actually buy a $5 million or $10 million deal. That's what I'm most proud of, because I think that is going to change their life financially. It's going to change their life personally, and it just gives them that much more freedom. So that to me is the most rewarding part of this job. Like nobody likes doing like loan paperwork, right? Like it's more just the people that you meet along this journey, and to me, that's probably my favorite thing. And if, I try to help, the way I like to think about it is when I was at GE, my job was to add value to like my manager, like one guy. Right. And then, even as a mortgage broker, I'll talk with like today, I'll probably talk to like 15, 20 investors. Right. So I'm adding value to all those guys. But then, if I do a YouTube video or do something like that and can help someone learn about multifamily financing, something that they didn't know before, that's like thousands of people.
Yeah.
And so I think just expanding the value that I'm able to provide, I think is super rewarding.
Yeah, no, I appreciate that answer. And just to close off, this class session, where can people find you, James? Your contact information at Old Capital and everything to get in touch with you.
Yeah, email is probably the best. So it's jeng@oldcapitallending.com. My phone number, 214-300-5035. You can go a couple websites. You can start at YouTube, just James Zhang YouTube. That'll start you off. Start there. If you want to see every deal that I've closed, you can go to txmultifamily.com, txmultifamily.com. Our company's podcast, Old Capital Podcast, is great. We've been doing that for like 5 years. Ton of information on there. And then our regular website, oldcapitallending.com, is where you'll find just like all the transactions that people are doing all over the country. And that's what I would say. I'll throw on one more website for everybody. So we're doing we usually have a once a year conference. We've had it in person every year except this year. So we're doing it virtual this year, oldcapitalconference.com. That we're doing in October. So that's another place to just get connected with other multifamily investors nationwide.
Yeah. And is there a link for that? Because, I'm going to start saying this. I'll drop it in the
just oldcapitalconference.com.
Okay.
That'll you'll go straight to the registration and you can see all the speakers and everything like that.
Awesome. Well, I appreciate it, James. This has been a short but sweet educational class, and I learned a lot from you, and I hope others too.
All right. Thanks a lot, Zach.